The Institute for Financial Literacy is a collaboration between MoneySense, the National Financial Education Program, and Singapore Polytechnic International. The Institute is the outreach arm of MoneySense. We conduct free and unbiased financial education programs for the public. MoneySense is Singapore's national financial education program set up in 2003 and is currently overseen by MAS, Monetary Authority of Singapore, and MOM, Ministry of Manpower. MoneySense aims to help Singaporeans manage their money well and make sound financial decisions on their own. This is the second video in a series of 3. In it, we will discuss the features of the different types of life insurance. Categories of insurance. There are 3 main categories of insurance. Life insurance. Policies can be unbundled or bundled. Unbundled policies are only for protection, and this would be mainly term insurance. While bundled policies offer both protection and investment, this would include whole life policies, endowment, and investment-linked insurance policies or ILPs. Health insurance. Policies that cover medical expenses, critical illness, long-term care, hospital income, and disability income. General insurance. Policies that cover motor, fire, property, travel, personal accident, etc. Features of different types of life insurance. These are the features of the 4 different types of life insurance: term, whole life, endowment, and investment-linked insurance policies. Term life insurance is for protection only. It is the most affordable and has renewable and convertible features. The premium is pegged at the new age when renewed or converted. Participative whole life and endowment policies provide protection plus guaranteed and non-guaranteed cash values. Part of the cash value is guaranteed, and the premiums do not increase with age. There are pay options which allow the policyholder to pay the premiums over a limited number of years. As for endowment policies, policyholders may be able to withdraw dividends or coupons. These policies are more expensive than term plans given the same level of coverage, and there is an element of investment risk. Investment-linked insurance policies offers protection plus higher potential returns. They have flexible features that allow cash to be withdrawn by selling the units in the fund. Certain ILPs also cover you for life. ILPs have investment risk, and mortality charge will increase as you age. Take note that there are fees and charges that can erode the returns. Interpreting your insurance documents. Your insurance contract is an important legal document, and here is some information that you should look for. Type of product, name of the plan, amount of protection, benefits, premium payable, projected cash value where applicable. Let us take a look at examples of different policies for a non-smoker 35-year-old male who has a budget of $300 each month. He wants to be covered for death and total and permanent disability. His age next birthday is 36 and age last birthday is 34. This is an example of a limited pay endowment policy where the policyholder pays for 5 years and the maturity date is at year 20. Based on the illustrated investment rate of return of the life participating fund for this endowment policy, at 3.00% per annum, total illustrated yield at maturity is 2.33% per annum. At 4.25% per annum, total illustrated yield at maturity is 3.30% per annum. This means that even if the participating fund makes 4.25%, the policy's actual yield is 3.30% upon surrender. We take a look at another example. This is a limited pay whole life policy where the policyholder stops paying at year 25. There is no maturity date, as this policy is meant to last for his lifetime. Even if the participating fund makes 4.25%, the policy's actual yield is at 1.78% upon surrender at age 74. The upper and lower illustration rates are used purely for illustrative purposes and do not represent upper and lower limits of the investment performance of an insurer's par fund. In addition, rates used in the policy illustration PI are not a reflection of the actual returns of both existing and future par policies. It is important to understand that the purpose of insurance is protection. If your priority is investments, then consider other instruments. Now, let's look at a regular premium whole life investment-linked insurance policy, or ILP. ILPs are different from endowment and whole life policies, as the cash value is not guaranteed and the selection of funds is done by the policyholder. In addition, even if the investment fund makes 8%, the policy's actual yield is 6.14% upon surrender at age 75, and the cash value is projected at 4% and 8%. Actual policy value can be lower or higher than this range depending on the performance of the underlying funds. Considerations when selecting life insurance plans. Here are some things to think about when choosing your life insurance policies. What is the purpose of the policy? Do you need investment returns? Do you need help to manage your investments? What is your budget for the premiums? Can you afford it in the long run if your personal situation changes? You can consider bundled products if you wish to have investment returns as well as protection. However, if your priority is protection only, then consider term insurance, which is more affordable, especially if you are working with a limited budget. How do you choose a suitable product? If your concern is protection and investment, you can always consider buying term insurance and investing on your own. Otherwise, you can consider whole life insurance or ILPs if you wish to meet both protection and investment objectives. You should also ensure that you're able to afford the premiums and understand the fees and charges inherent in ILPs. For assurance of regular cash payouts, you can consider endowment products that offer this option, or ILPs that offers flexibility of withdrawing cash. Note that there are recurring charges such as management fees and mortality charges, which are paid by deducting the units from your portfolio. Before you buy any insurance product, consider the following. Affordability. Work out your budget, as insurance is a long-term commitment. Consider changes in employment. Example, if you or your spouse stop working. Policies with cash values, if surrendered too early, will result in zero or very little cash payout. Consider term insurance to keep your premiums low. Priority. Prioritize your protection needs over insurance with savings or investment elements. Switching. Make sure the new policy has the same conditions as your previous one, unless you intend to downgrade. If your health has worsened, check if the new policy has additional exclusions before you terminate your current one. Any decision to replace a policy should be taken only after careful consideration. It is also important to note the impact that terminating or amending your policy can have on your insurance coverage. Terminating a policy prematurely may result in a financial loss, as typically the surrender value, which is the cash value you receive for early termination, may be lower than the total premiums paid. When engaging a financial advisor, you should consider and look out for these important factors. Sign only when you fully understand what you are signing. Make sure you ask for a copy of signed documents. When in doubt, always seek clarification. Be careful of verbal promises and guarantees of high returns. Deal only with financial advisors regulated by the Monetary Authority of Singapore. Also consider product suitability, investment risks, payment duration, and affordability. Some tips to bear in mind. Create a summary of your policies with an overview of your coverage and premium payments. Review your insurance portfolio regularly or when your personal circumstances have changed. Update your insurer when there are changes to your personal details. Here are the key takeaways. Life insurance policies are long-term commitments. Make sure you buy what you need and what you can afford. Understand that the purpose of insurance is protection. If your priority is investments, then consider other instruments. Understand the features of the products and how they can meet your needs.